It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, smartest guy in the room, the governor of Beckerville. I think that's an honorary title.
Honorary, yes, very honorary.
Mr. Michael Becker.
Hey, Paul.
How are you today?
Doing good.
So, as everybody knows, Michael's gone from loaning the money to owning the real estate. I think he had, 14, 15 single-family homes, and he's brought that into 6,000.
Yeah, we've done about 6,700 units when the year's over. We'll own about 4,500 in the portfolio as we close out 2018 here.
Get to know Michael and his group over at SPI. So they've done a great job. So in the podcast today for the question, Michael, people moving to Texas from California, what type of an impact is that going to have?
Yeah, so Paul and I were just talking how we read an article in the Dallas Coin News recently that we'll try to link to in the show notes here, but that Jim Gaines, who took over for Dr. Dotzauer, who we've had speak a few times. So if you haven't been to one of the Old Capital speaker series, I'm sure we'll fire that up here in February or March again. You certainly should do it. And we typically have, when does Dr. Dotzauer come out? In April, typically?
Correct.
So in April, if early save the date for some generic day in April, I would certainly recommend you guys coming out and see Dr. Dotzauer. But his successor was Jim Gaines, and he was giving a speech to some group, and how he mentioned they were talking about all the growth of Texas. And people kind of try and predict the future of Texas. And he said, well, in 30 years, Texas is going to be California. And everyone in the crowd full of Texans groaned and dismayed that we turned into California, because we're all proud Texans. But I'm just joking here, sitting in the room. Paul, where did you live in Ventura County for a while, I believe, right?
I came from California before I came to Texas. I got mine, so hell with you.
Paul's ahead of the curve by 25 years now or so. But in all seriousness, as our state grows, one of the things I've been kind of quoting for a while, misquoting for a while, was just the kind of the projections, what has happened and what are they projecting to happen for population growth in Texas in general, but Dallas-Fort Worth specifically, which is where I live and do most of our business here in Dallas-Fort Worth. And to kind of take a step back, in 2010, so 8 years ago, there was about 6.5 million people in the MSA of Dallas-Fort Worth. As we kind of close out 2018, there's about 7.5 million people in Dallas-Fort Worth. So in the last 8 years, we've grown by 1 million people. And what I've been saying for the longest time was by 2040, they're projecting there'll be 10 million people. And then when I read this article, I realized I was misquoting myself. I'm misquoting the stat. The stat was actually by 2030, there's going to be 10 million people. So you're talking about 2.5 million more people they're projecting to come to Dallas-Fort Worth, or grow by about a third. So it's basically like taking the entire MSA of either Charlotte or Orlando and then dropping it on top of Dallas-Fort Worth. So that's kind of what they're projecting. And that's very similar percentages in Austin and Houston and San Antonio as well. And then the secondary markets as well are going to kind of grow in similar percentages to what Dallas-Fort Worth is. So that's just a staggering amount of people. And what the article was saying is that as you have all these people and these big city problems, you're gonna start getting different solutions for those things, and kind of look at California as probably what our prediction of the future is going to be. But that really kind of just underlines the support that we're 8 years or so into an expansion of the apartment market right here. Rents have been going crazy. I mean, rental rates are materially higher than what they were. The prices have, more than doubled on these apartments in the last, 7 or 8 years. So one of the common questions I get is, is this a bubble? Are we going to peak? Is this going to be the end of it? And, kind of some of the things I think about, that, depending where you are in the market, depending on what markets you're in, what submarkets you're in, these answers could be a little bit different. If you're in San Francisco, it's probably a different answer than if you're in Dallas or Atlanta or Phoenix or someplace like that. But if you do the fundamentals right, you buy in good locations, you have the well-capitalized deals, you set your debt structure up properly, we have long-term fixed rate debt, you get a lot of forgiveness in this business. And then if you just own good quality real estate in good locations, say in Dallas-Fort Worth, and they drop the equivalent of the entire MSA of Orlando on top of us over the next 12 years, and you have a 12-year fixed rate loan, like a lot of the loans that Paul gives out, I mean, I don't see any possible way that rents won't be materially higher in 12 years from now, if that is anywhere near accurate with the population projections here in Dallas-Fort Worth. The rents have to go up. And the way these apartments work, For every dollar in revenue you generate, on average, you get 50 cents in NOI. So, values cap rate divided by NOI. So your cap rates can go up, your cap rates can go down. But if your NOI, if you have material rental rate growth, you should have material NOI growth. And the win should just generally be in your sales from that perspective. So, you still got to do the fundamentals right. You still got to buy right. You still got to structure it well. You still have to execute your business plan. But, generally speaking, if that's anywhere near accurate and you own properties in Texas, you should be okay in the long run.
Let's talk about Michael Becker's rule number 1.
Yeah, don't buy in the hood, right?
And again, why is that? Why is that so important?
These deals right now, everything's full. The entire city's full. More people are going to come. It should be supportive and stay full. So that's it's been good times right now. But what I feel people are mispricing or not taking the risk adjusted return part of this business into it. They're getting returns, but they're not really kind of realizing all the risks they're taking with it. So, when the economy slows up, the places that tend to be in higher crime, lower socioeconomic areas, there's a definite difference between physical occupancy and economic occupancy. In like the last podcast, last Mike Mondays, we talked about, kind of that workforce housing and being supportive and affordability being a challenge. It's really going to hit the lowest end of the economy the worst when the recession hits. They simply don't have the money to pay their rent. So they might be living in your unit, so you might be, occupied, but it's even worse because they're not paying your rent. So Paul always says it's easy to fill them up. It's hard to collect the money. And that's even more true in the higher crime areas. So I think they'll tend to be a little bit tougher to operate. And then the other thing, which major markets have over secondary markets, this is kind of the same phenomenon from buying in good submarkets versus the higher crime submarkets, is the liquidity is going to be gone. So if you own a property in Plano, Texas, for example, which is a top flight market in one of the major metropolitan areas of Dallas, then you can always sell that property because there's always liquidity in that market. If you own a deal in Killeen, Texas, or you own a property in South Dallas in a high crime area, the buyers that are left in the marketplace will seek quality because it's going to be on sale. So they're going to go to the quality first. And it's not to the very end that the lower end submarkets, so the secondary type markets, actually start catching up. So, that's another thought that I have on that topic.
My thought is really through the eyes of the passive investors is that you have to ask questions to maybe some of these new sponsors or the sponsors that have had success in these areas in the past, is that if they have had yields that have done fairly well, and all of a sudden those yields are not there, they can't find inventory. They'll step down to a more crime-ridden place to try to enforce the higher yields. Again, you can put any kind of numbers on the piece of paper, but one of the things that I would challenge people on is rental growth. And rental growth should be 1.5%, say 2%, if that. But sometimes they show 3-4% rental growth, and that is just not achievable. So I would say challenge people that if they're squeezing for yield and they're buying marginal properties, they may be stepping down the quality of the property itself, and make sure that their business plan is the same side of what your business plan is, and that you do your due diligence and actually start calling around, make sure the crime reports are done, kind of get a general idea of what this property is, because typically in marginal areas you may have older properties, and these properties tend to kind of wear out faster with older technology. What's your take on that?
Yeah, and the tenants are tougher on the units as well. So, one of the things I say all the time is these properties, they're kind of older and tougher areas. They have all these non-recurring expenses that recur all the time. So, your sewer pipes go down, the tenants beat the units up. It's just harder to run those properties. And while those are items that are below the NOI line, so it doesn't necessarily impact your NOI. It's a real cash expenditure because your plumber wants to be paid with cash, right? So you have to actually pay them in cash. So if you're having all these projections and not having these proper reserves set aside for these non-recurring expenses, and you own a deal in a tough area and you think you can get in and out of it in 2 years, if you can, that's great. 2-3 years is not a big deal because they haven't worn out. But, if you get stuck in a down cycle and you have to own that thing for 6 or 7 or 8 years, what gives is yield, because you got to retain all your cash to, address these capital items, or the city gets on you. And then once the city gets on you, then it kind of snowballs and you can't lease your units, and then your occupancy dips, your collections dip, and there's just kind of a bad cycle that you get into. So just, beware, buyer beware. All the cap rates, I've been saying this for a while, all the cap rates are basically the same regardless of property grade or location, and that shouldn't be the case. There is risk in these deals, and people aren't properly accounting for the risk-adjusted return. So just because it's worth the last 2 or 3 years doesn't mean historically it's the right move to do. And I feel like I've been the boy crying wolf for a while, saying don't buy in the hood, because I've been wrong in the recent past, because you would have made as much or more money, because cap rates kept compressing and the rental rates growth was kind of late stage, where the places the better located deals have the rental rate growth earlier, and then these are kind of lagging, caught up. But at some point, trees don't go to the sky, and some point, it's got to correct.
One of these days we'll be right.
One of these days, that's right.
So that was Michael Becker. Michael, if someone wanted to get more information about what SPI Advisory does, can you tell them how to get in contact with you?
Yeah, the best way to find out more information about us is simply go to a company's website, which is www.spiadvisory.com. That's SPI, like spy, advisory.com. And on there's a contact us page. Fill that form out. I'm always happy to have my assistant set up a call and have a 10 or 15-minute telephone call with listeners of the podcast, or anyone that wants to find out a little bit more information about what we do and how to work with us.
That's great. Some great information. Michael, as always, we appreciate your time. Again, Michael Becker, I'm Paul Peebles. Have a great day.